Think about the last time you did some extra chores, maybe washing the family car, and were handed a crisp new $10 bill. Before money, trading a toy for a sandwich meant hoping the other person wanted your toy. Money solves that. It has 3 jobs: buying things, saving rewards for later, and acting as a measuring stick to compare prices. People used to use shells, beads, and metal coins to do these jobs. It was 1862 when the United States government first started printing paper dollars. The only reason those early paper bills, or your $10 today, work is because we all agree they have value. That shared trust makes money the perfect container to hold the value of your hard work until you are ready to use it. So you take your $10 and slide it across the counter to a bank teller. You want to keep it safe. Leaning in, conspiratorial. You might imagine your $10 sitting in a dark, heavy steel vault, gathering dust while it waits for you to come back. Instead, the bank is an active lender. It takes your deposit and lets someone else, like a local baker, borrow it to buy an oven. When the baker repays the loan with extra money, the bank shares a portion with you, called interest. A bank is really a massive recycling engine. It gathers up money that people aren't using right now and pushes it back out into the community to help small businesses grow and hire people. Now, let's say a whole year passes. You take your saved money to the store to finally buy that $10 comic book you've been wanting. But when you look at the sticker, the price is now $11. That extra dollar on the sticker is a real-life example of inflation. Over time, the prices of the things we buy tend to creep up. This means your $10 has less purchasing power, which is just a fancy way of saying your money can't buy as much as it used to. The first reason prices rise is heavy demand. If many kids want the same comic book, the store raises the price. The second reason is higher manufacturing costs. If a factory pays more for paper, they pass those extra costs on to you. The final cause happens when a government puts too much new money into the economy. If everyone suddenly has extra cash in their pockets, but the number of items for sale stays the same, sellers will naturally charge more. Now, a tiny amount of inflation, about 2% a year, is considered normal and healthy. It encourages people to spend rather than hoard cash. But when prices skyrocket rapidly, families struggle to afford basic necessities like groceries and rent. If no one stepped in to manage the system, inflation would act like an invisible thief, constantly shrinking the value of the money you worked so hard to save. To protect the value of your money, the United States has a central referee for the banking system. It is called the Federal Reserve, or simply the Fed. The Fed's entire purpose is to keep the American economy stable, make sure as many people as possible have jobs, and keep prices from rising too quickly. This immense responsibility rests with a group of experts called the Board of Governors, overseen by a leader known as the Chair. Today, that chair is Jerome Powell. To control inflation, the Fed adjusts interest rates, the price of borrowing money. They operate like an economic thermostat. When inflation gets too hot, they turn the interest rate dial up. This spikes borrowing costs, making loans expensive, which drops overall spending. Making borrowing painful is a very deliberate strategy. By making loans expensive, the Fed forces people and companies to borrow less and spend less, giving the heated economy a chance to cool off. Let's follow this back to the local baker from earlier. Because the Fed raised interest rates, taking out a bank loan for a second oven is suddenly too expensive, so the baker decides to wait. Because the baker doesn't buy the oven, the factory that makes ovens earns a little less. The factory workers have less extra cash to spend in town. Slowly, overall spending in the community drops. Local shops like the comic book store stop raising their prices to keep their remaining customers. That decision made by a group of economists in Washington, D.C., flowed through every part of the economy, ultimately keeping the price of your comic book stable. That crisp $10 bill you earned is a simple tool, but local banks multiply its power. Inflation constantly threatens its value, and the Federal Reserve monitors the economy to protect it. A single piece of paper connects you directly to the mechanics of the global economy.